So here we are, the final step of the accounting cycle. We're going to do our closing entries. So at this final step, we're just going to close out some accounts, and these accounts are called our temporary accounts. So we have real or permanent accounts, and those are assets, liabilities, and capital, and those accounts will carry over from one accounting period to another. But our temporary accounts, those are revenue, expenses, and then withdrawals. We also want to keep track of how withdrawals changes each period, so we'll close them out too. So these are called temporary or nominal accounts, and their balances won't carry over from one accounting period to the next. Instead, we're going to zero those out, and this process will allow us to obtain new data for our revenues, expenses, and withdrawals for each accounting period. And this is helpful for many things, many reasons. This process of closing will summarize our effect of revenues, expenses, and withdrawals on capital. And then also it makes a great tool to have it refreshed each accounting cycle for external parties like creditors and investors. We're looking at how we're doing on our income statement each time. Each accounting cycle, and also even for internal reasons for planning and forecasting purposes. So we're going to do some closing entries to close out these temporary accounts, the revenues, the expenses, and then also our withdrawals. And then we're going to do a post-closing trial balance. So we'll have a couple videos just to break up the video as we learn this. So here we have is our adjusted trial balance, and this was from the worksheet. So if you look at the worksheet again, you'll see our completed worksheet with our adjusted trial balance here, and all of this has now been plugged onto that sheet for an adjusted trial balance, and it's $80,000 for the total. All right, so let's go back over to the main one. This is nicer looking. Okay. So we have all these items here, and we can see here we just learned permanent accounts are real accounts that just stay. They're going to keep accumulating their balances each accounting period, so those will stay all the way down to capital. All right. Our withdrawals is one that we're going to close out. So we're going to close out this withdrawals. We're going to close out revenue from clients, fees earned, or whatever they're going to call it, sales revenue. I just did revenue from clients for us. And then we'll close out expenses. So these 5 expenses need to be closed out. So all these from withdrawals down are going to be closed out. Those are our temporary accounts. Okay, so we're going to go through that process. So our first step is to close out revenue balance. So most books do this in this order of steps. So we're going to go in that order. So we're going to close out revenue from the clients. So we can see here that we have a credit balance, right? A credit balance for revenue, and we want to make that 0. Well, how do we make that revenue balance be 0? Well, let's just draw a T account, because you know I like to do T accounts for planning purposes. And so we'll make a T account. Okay, so revenue has 42,000 credit side, and I need to make that be a 0 because I want to close it out. It's a temporary account, so I'm going to make it 0. Oh well, I'll debit. I'll do a debit to revenue for 42,000, and that will make it 0, right? Credit minus debit got 0. All right, so I got a debit, but I need a credit for my journal entry. Well, we're going to make this new account. It's a temporary account as well. It's called our income summary. It's to keep us organized. We're going to dump everything here for revenue and expenses. We'll talk about withdrawals later. But revenue and expenses, we're going to dump them over to this account to get us to balance for our debits and credits for our journal entry. And then we'll close out this income summary account. So we did a debit to revenue, so I need a credit. So I'll do a credit to income summary. Okay. And then I will now start doing the journal entry. So I have a debit and a credit. So let's go ahead and record that journal entry. I called it revenue from clients. So now revenue is going to be closed out when I post that to the ledger. Now I have to close out all these expense ones. So these 4 expenses. Well, how do I record it? Well, we'll do the same thing. So we have, let's just do one for an example's sake, but you'll get the idea. So we have wages expense. Oh, rent expense is our first one. So let's do rent expense. So rent expense has a debit balance right now. And I need to get it to be 0. Okay. I will credit rent expense. So what am I going to debit? Well, we'll debit income summary. But you know what we're going to do? We're going to do this to all the expense accounts. So we'll make a T account for wage expense. And we'll do the same thing. We'll end up with a credit for $13,000. Depreciation expense will end up with a credit for $5,000. Insurance expense will end up with a credit for $2,000. And then supplies expense, a credit for $2,000. We'll add those all up, and then we'll debit that total instead. So let's just get a calculator here for us. I went on the wrong screen. Let's get over here. So we have 11,000, 13, 5, 2. So after we make a T account for each of these expenses, so each expense account will have a T account like rent expense. We're going to add them all up, and we should get 33,000. So 33,000 will be my debit for all of them. All right, so we'll have all these credits to all these expenses, and then one debit to income summary for 33,000. So we know our debit now. So let's record that, because we always record debits first. So let's record income summary. And I can see here that I need more spaces on my general journal. So I'm going to press pause and make those spaces for us. Okay, that should be enough. So which one did we do first? We did rent expense. Perfect. So we have a credit for 11,000 for rent expense. And then our next one was, let's go look, because I already forgot what we have. We have wage expense for 13,000 and depreciation expense for 5,000. All right. So those were debits. Now we need to credit them to close them out. So wage expense. I already forgot. What was it? 13,000? We'll go check again. And then depreciation expense. $13,000 and $5,000. Okay, and then we have insurance expense and then supplies expense for $2,000 for both of them. And those were debit balances, so we want to close them out. We'll close them out with credit balances. What was it already again? Insurance and supplies. And you know us accountants, we like to double check. So you would check all those credits to make sure it really does equal what we just did. I mean, we just added it, but let's check again. Right, 43, perfect. My debits equal my credits. So instead of doing a bunch of individual income summary ones debited, we're just going to debit the grand total of all the expenses added up to one income summary debit. All right, just makes nice and clean that way. All right, so next we have is step 3, close out the income summary balance. So we have this new account that we made just to keep us organized, and that was the income summary. And we can see that it has basically our income statement items. It has our revenue for 42,000, and it has all our expenses for 33,000. So we're going to close out its balance. Well, we got to find the balance that it has, and we can go and verify. We had our worksheet before, our completed worksheet, and we can see here that we can confirm things. We see that the 42 is here and the 33, right? And oh, okay, yes. And then so it agrees 9,000 is my net income amount as well. So that is the ending balance of 42 minus 33. It is a credit side balance of 9,000. I want to zero out that 9,000, and so I'm going to make a debit for 9,000 to close it out. So let's just move. I'm just going to erase this, I know, so we have more room. All right, so I want to close out that. I want to make that 9,000 be a 0. So what do I need to do? I need to do another debit for 9,000. All right, so I'm going to debit my income summary for 9,000. What am I going to credit? Where am I sending this to? Well, we're sending this to capital. It's increasing capital. We can see capital's normal balance is a credit of 19,000 right here is our capital. All right. So that's what it was, but now we're rolling up. We're going to roll up all our revenue and our expenses to this capital account. And so our capital account actually is going to grow by 9,000. So we'll do a debit to income summary and a credit to increase, because that increases capital by 9,000. Perfect. All right, so we closed out that. So now all our temporary accounts, revenue, expenses, the income summary, they are all, oh, it's S. Archer Capitals. Let's put that in. Let's be, okay. So now we are done with all those. There's one more we don't want to forget, and that is withdrawals. So that is one special one. That one doesn't get rolled up into income summary. Instead, that one is just going to go straight to capital. So let's close out withdrawals. So withdrawals has a normal debit balance of 8,000. So how do I close it out? Well, I could do my T account, and I'm going to do a credit to close out withdrawals, right? And close out that debit with a credit. So withdrawals will be a credit. And then what's my debit going to be? I'm going to just go straight to income summary. So my debit will be S. Archer Capital. So straight to capital. I think I might have said that wrong earlier. So we're just going to go straight to capital with our debit for 8,000. All right. And to get rid of withdrawals, which had a debit balance, we'll do a credit. And hey, we're done. And so those are our closing entries. We'll post them to these accounts, and then we're going to go ahead and do our post-closing trial balance in the next video.